Welcome back to Talk Tickers. Today, we're digging into Indie Semiconductor's Q3 earnings call. And let me tell you, it was a wild one. A total roller coaster after the bell.
Oof. Yeah, that's a big red number. The market's reaction was swift and pretty brutal. The stock absolutely plummeted in after-hours trading. We're talking a really tough move for a company that honestly had been doing pretty well compared to its peers.
And here's the kicker. This wasn't just a garden variety bad reaction. The stock blew right past what the options market was even pricing in as a worst-case scenario. That tells you this was a huge, and I mean huge, surprise to the downside. So the big question is, what in the world happened on that call? All right, so here's how we're going to break it all down. We'll look at the after-hours shock, check the Q3 scorecard, hear out management's long game, give our own analyst take, and then wrap it up with our rating for the next call. Let's get into it. First up, let's look at the numbers. This is really where the trouble began. So as you can see, Indie came up just a little short on both the top and bottom lines. We're talking a miss of a penny on EPS, and they were just a hair under on revenue. Now, was it a total disaster? No. But in this kind of market, investors are looking for perfection, and this was just enough of a miss to really spook them. Okay, so while the market was zeroing in on that quarterly miss, management was on the call trying to paint a completely different picture, a much, much bigger long-term story. They really wanted to shift the focus from the next 3 months to the next 10 years. And this is the number at the heart of their argument. $7.4 billion. That's their strategic backlog, and it's a monster. Basically, it's a huge pipeline of future business that's already in the books. You know, this right here is the absolute core of the bull case for the stock. And it's not just a big number on a page. They backed it up by pointing to some really exciting new wins. We're talking about their tech being used in next-gen radar, getting their first shipments into humanoid robotics with some big names like Figure.ai, and even getting into things like self-driving robo-taxis and quantum computing. It really shows their technology is getting a foothold in some seriously high-growth areas. Okay, so now for our take. This is the real puzzle, right? You've got this incredible long-term story with a giant backlog. And then you have a stock that just got hammered. So what gives? What did the market see that made them ignore all that good news? Well, the answer comes down to two things. What they said about the next quarter and a pretty critical supply chain problem that basically threw a wrench in everything. So here's the culprit, a shortage of something called package substrates. Think of it as a crucial packaging component for their chips. Management said this is going to be a major headwind for them. And it's not just their problem. This is a ripple effect from the absolutely insane demand for AI chips hogging up all the supply. And you can see the damage right here in their guidance for next quarter. The shortage is going to knock about $5 million off their revenue. But the really critical part, the thing that probably scared Wall Street the most, is the hit to gross margin. Look at that drop. From nearly 50% down to the mid-40s. That is a huge drop in profitability, and it's a massive red flag. Now, the CEO, Donald McClemment, he tried to calm everyone down, saying, it's just basically a short-term thing. He thinks it'll be sorted out by early next year. But here's the problem. The market absolutely hates uncertainty. And when a CEO says short-term, investors hear, we don't know when this will end, and that's scary. So this slide pretty much sums up the entire bear case. 1, they missed this quarter's numbers. 2, their profitability is going in the wrong direction next quarter. And 3, there's this big cloud of uncertainty over their supply chain. The market is laser-focused on these 3 problems and is completely, 100% ignoring that giant long-term backlog for now. All right, so that brings us to the big finale. Where do we stand on all this? Let's talk about our rating. It really is a classic Wall Street tug-of-war, isn't it? The bull case is all about that massive $7.4 billion backlog, the cool design wins, and the fact that the stock is a lot cheaper now. But the bear case is just as real. You've got execution risk, that's scary pressure on margins, and the supply chain headaches. So, after weighing all that, we're initiating coverage with a market perform rating. Look, the long-term story here is really compelling. We get it. But those margin issues and the supply chain problems are serious overhangs. In our view, they justify the painful hit the stock just took. It's kind of stuck in neutral for now. But before we go, let's talk about a potential trade idea. This is for all you options players out there. It's a bit of a different way to think about this whole situation. So the thesis here is pretty simple. Forget trying to guess if the stock is going up or down. Instead, just bet that it's going to move a lot. The reason is this huge disconnect between the great long-term story and the messy short-term problems. That creates a ton of uncertainty, and uncertainty is fuel for big price swings. So the play could be something like a long-dated options straddle, which makes money as long as the stock makes a big move in either direction. Once we get clarity on the supply chain, the stock is probably not going to sit still. This is not financial advice.